Okay, folks, before we get started with the price action support series, I wanted to go over a couple things just so that we're all on the same page and just to give you a little bit of direction before we get started with the details and price action. But first of all, risk disclaimer, if you can kindly take a moment to read through this. All right, so hopefully you all understand the risks in foreign exchange. Actually, the main risk comes from the excessive use of leverage, and we do some lessons on that as well. So just to get started, I want to walk through this methodically, just so that we're very clear, we're on the same page. What do I need to do to become successful? I am very often asked this question. I'm sent emails to chrislaurie.com and very often asked this question. And so there's a few things. First of all, it's very important to understand that this is a process. It is a process of acquiring information and structuring it in such a way that when interacting with the market environment, you're aiming to establish a certain set of parameters that put probabilities in your favor when it comes time to execute a trading decision. So we want to just build a little bit of a directional framework to start with before we get into some of the details, just to give you a little bit of direction or lead in terms of how you should be thinking as you take on the information, because this is not a copy me system. I want to bring you through the process of understanding the market at a deeper level, establishing a framework and a connection with the market that ideally connects with your psychological profile, with your understanding of the market, that which you connect with, that which you adapt well, that which connects with your line of thinking, so that you can become highly proficient within a specific area, because you only need a small niche in the marketplace in order to be profitable, and focusing in on that niche that is specific to you, and it does not need to be validated by anybody else other than yourself and your own validation process. So what we want to do is many of you may have been randomly going out and trying to observe aspects of price behavior or price movement, be it with the use of mathematical models, algorithms, mathematical indicators. Some of you might be price behavior, but maybe you just don't understand the price behavior at a deep enough level, or have not built a structure in order to focus in on a specific area of price behavior in order to get any substance or basically a grasp on any trade framework or trading model and risk model. So you need to internalize the details retained from market experience. So each time you engage in a market experience, it's important to understand you need to connect with the experience with that which is real. And over time, over large sample sizes, you begin to start to see some consistencies in price behaviors as a result of any of the whole spectrum of aspects that can affect price behavior, be it price delivery or long-term fundamentals. So I've broken it down into three basic parts here: fundamentals, technical or price behavior for us, or psychology. Now, on the technical side, we only really study price behavior, so it's really going to be price behavior focused. We're not going to talk about indicators at all, or any other technical references to price movement. So just in general terms, what I've done is I've just kind of broken it down. So what I suggest you do is I suggest you start to read the fundamentals, and at first it might not make sense. So just simply read through the fundamental overview of what is happening on a broader spectrum, as well as what is happening in the short term, in terms of the short-term behaviors. And so we want to observe the fundamentals and slowly become acquainted with the terminology, the consistencies, and sort of the general and establish overall a general connection between what's going on fundamentally and what's happening with price volatility. So what a larger overview is going to do is it's typically going to focus really primarily on monetary policy. Monetary policy is the anchor. So everything that comes below monetary policy is directly or indirectly affecting monetary policy. And so from monetary policy is broken down into data. So we have a multitude of data points that come out throughout the week on specific days at specific times and certain rhythms in terms of monthly, quarterly, semi-annually, annually, and this data drives the decision-making process of the central banks in terms of the direction of monetary policy. Now, typically, FX flows move toward yield, so we typically move toward a policy tightening phase where interest rates are rising. You typically will see funds flow in that direction, and over time you're going to see that there's a distinction between what's happening on a very, very macro level versus the shorter term drivers of the market in terms of what the market's view is, its influence as it pertains to the broader picture of monetary policy. And that, of course, is going to create an environment. So you're going to have a macro environment in terms of the market's view of which direction a currency is going. So if we're looking at the direction of a currency moving from A to B in a course of 3 months, 6 months, a year, and that's maybe more a macro scenario. We may see short-term scenarios where the longer-term direction is being disrupted by maybe some negative data flow or a string of positive data flow, where the longer-term perspective is just being disrupted or dislodged or is deviating for a short period in the longer-term trend. And so what it's going to do is it's going to create short-term, call it sentiment, or a short-term view or a short-term state of the market or market environment that's going to influence price movements. So what I'm suggesting here is really get connected with the fundamentals as it is anchored to monetary policy. Watch the short-term data and the volatility that the short-term data generates. So over time, you will internalize the effects of the macro factors on short-term price volatility. Now, when we look at price behavior, we are only looking at naked charts, as you know. We are looking at on the very, very, very short term of the spectrum. We're looking at micro price delivery and then micro volatility of what's happening with price behavior on a tick for tick basis. So that is sort of the core or the anchor, understanding in depth how prices deliver to the market and picking up on specific behaviors. Of course, there's the macro state as well. Of course, this is fractal. We refer to it as in terms of seeing identical patterns on a macro level as we do on the micro level. We will get into that throughout this course. Now, when it comes to your intraday trading, we will specifically identify specific price behaviors, but it is entirely up to you to go through a process of validating the behaviors, because with what I share as a specific price behavior that I've learned over a good number of years, you will see the price behavior slightly different than I will. And as you become more mature and go through larger sample sizes of validating the price behaviors, you'll continue to see it slightly differently. Not only that, where the value is in this is you will see it in a way that connects with your own mindset, with your unique way of looking at the market. Then it becomes more accommodating that your trading model is formulated in such a way that it becomes uniquely your own and unique to your view, so you will have full understanding of it, and nobody else needs to understand what you do, and nor do they need to validate it. Okay, only you need to validate it over large sample sizes. So as this breaks down, you will become more tightly connected with volatility drivers as it relates to the process that you are engaged in, and having a deeper understanding of fundamentals, monetary policy, data, and the overall general environment. You are going to connect this with this, okay? And not only how it all connects, but what type of market response you can anticipate or simply remain neutral on, or decide that you're not going to have any anticipation whatsoever. And then later the price behaviors will actually start to show you the story, because you've gone through the process of understanding these things at a much deeper level. In the process of mechanically internalizing these two sectors and blending the sectors in the appropriate way, you're going to go through a process of refining your psychology as it pertains to building your model, understanding the technical and fundamental price behaviors, building your model as it relates to your unique psychological profile. It will become more tightly connected with specific aspects of the market, and you'll ultimately start to refine not only your model development from a technical and fundamental framework, but you're also going to build a psychological framework. Very important. So understanding the depth and the parameters of your psychology and having that framework work together with the technical and fundamental framework that you're establishing as well. So you're going to develop a maturity. Your mindset's going to develop a psychological maturity in a way that's going to create a trader that lives within you. And you are ultimately going to become an independent thinker in this market, because you will not succeed until you become a fully validated, structured, independent thinker. And that is the point that your trading really starts to take off, is once you've developed these to a certain breaking point where you are fully confident in your ability to internalize and understand and assimilate price behavior and build a framework for consistent trading. When you become an independent thinker, that's when your trading will take off. To look at this a different way, this is something that I developed a few years ago, and it's called the Developing Traders Model. You've all probably seen it already in some of the previous videos, but for the sake of this course, I want to go over it again. So it's called the Developing Traders Model, and each one of you in the current marketplace, you have a current reality. Your reality may be completely beginner. Your reality may have tried copy me systems. Your reality will have gone through maybe some deviant process where it's resulted nothing and has ended up in frustration. Your reality is every one of you listening to this has a different reality. Okay, and it's important that you come to terms with your reality and start to work through the process of either reframing your reality or refining your reality. So your reality, basically what happens is whatever level of maturity you are currently at, you're going to continue to go through a process that will refine your current reality and bring it to a higher level or refine it even more. Now, if you are deviantly awry on your risk mentality, then you can actually, your current reality can actually decline. Okay, but we want it to progress. So naturally, every one of you is going to go through an exploration process. You're going to go out and you're going to explore. You're going to try indicators, indicator systems, algorithms, copy me systems, do what I do, step-by-step systems. You're going to try automatic trading things and gadgets, and you're going to try all different forms of trading rooms, copying with some of the trades that other people do in trading rooms. Some of you will be more diligent and more methodical. Some of you will not take any risk at all. Some of you will not even put any money in the market. Some of you will have erratically put a bunch of money in the market and while knowing nothing and losing it. Some of you are at break even, which is to me is an amazing start, to be at break even and to be disciplined enough to maintain your equity. So you're going to go out and you're going to explore all aspects of the market in a relatively unstructured way. And it is important that structure is not copying what somebody else does. Structure is building, having a development plan to build your own trading development process. So and I'm going to, and of course in Pro Traders Club, we're sharing with you materials and direction in that respect. And what we're doing is we're basically cutting out running around trying all kinds of things and getting you to focus within a specific area. And to help you to gain an intimate understanding of the market, internalizing price behaviors and refining them to your own psychology and finding the trades that you like within a specific framework that you have adapted. Okay, so our job is to have spent many years identifying price behaviors and market movements and other aspects of the market so that you don't have to go through that process. You can start by understanding them rather than finding them. So then you'll move through a phase where you this process will actually start to develop your trading model or your trading self, and you may be heading in the right direction, you may be heading in the wrong direction. For everybody it's different, or you may be going nowhere. So you actually start to get a basic understanding that there's framework required in building a trading model and guiding decisions, and there's also a framework in guiding your psychology. You will, if you have framework, you will actually be internalizing experiences by reading fundamentals and getting acquainted with data points and volatility that is driven by data points and aspects of fundamentals. You are slowly internalizing these behaviors. It may be in a refined way and it may not be in a refined way, but you want to slowly refine this over time. Okay, so you're internalizing experiences. In the meantime, you're always engaging in experiences in some way, shape, or form. Watching the market, back testing the market, doing live exercises in the market, having a structured development plan in the market. You're always engaging experiences while this is taking place. Each time, the more structure you have and the more experiences you engage in and the more you internalize, you're actually raising your level of consciousness. And for some of you, you may step outside, as an example, you may step outside your risk parameters and you get stung badly, and you come back and you say, well, I know not to do that again. You're actually raising your level of consciousness in terms of your sensitivity to maybe not knowing enough about the market or not having a tight enough framework, both from a trading model standpoint and a risk model standpoint. On the other hand, you may be starting to identify highly consistent price behaviors that you can start to get a handle on, and you can actually start focusing on where certain behaviors actually start to lend themselves to high probability trades. So you can be raising your level of consciousness on all levels, because it's equally important to be raising your level of consciousness by refining and gaining an increased depth of understanding of the market, as it is increasing your level of consciousness from a negative standpoint. Negative experiences as it pertains to price behaviors, negative experience as it pertains to your risk model. And so both of these things, both the positives and the negative, both bring you to a higher level of consciousness as it um, refers to building your trading model, your psychological profile, and so forth. So then you become wiser, and you're slowly increasing and improving and refining your current reality. The more you engage in structured processes and go through this phase, the more you are increasing, refining your capability to become an independent thinking trader, and your current reality is having a much, much clearer vision of the market. How many of you can look back 1 year on your current understanding of trading, 2 years, 3 years, 4 years, and consider how much more you know now than you knew back then? So if we can bring a little more structure to it, then we can actually get you to the point where you become consistently profitable. So your current reality will continue to rise and be refined on your way to becoming an independent thinking successful trader. You'll continue to explore, you'll continue to develop, you'll continue to refine your model as the market environment changes. You will not believe how much depth of understanding is out there beyond what you currently know. And even now, I need to stay on top of things virtually every day in order to continue to grow and refine and maintain the refinement that I've brought to my trading and risk models. Your level of consciousness is constantly rising, you're becoming wiser, and your current reality rising as well. Looking at this another way, explaining the same thing in a different way, is that you have your unique mind. Okay, this is you, and nobody else is like you. No one can copy the way you think, which is why you cannot copy the way other people think. You cannot copy their experiences. You have your own unique mind, and you are trying to develop a unique model that connects your mind. Okay, the two, if your mind has developed and refined the specific areas and price behaviors that you are looking to trade, no one can take that away from you. No one can take away the experiences that you have, because nobody understands you and nobody needs to validate it. So what's ultimately going to keep this process in tow is number one, properly structured exercises and development process, but also a unique development model. Okay, so unique, I mean risk model. So that is accustomed to the way that you trade and the way that you think. If you deviate from this, then don't place the blame on the model or on the mind. Actually, the blame is on the mind, because the mind makes the decision that you deviated from your risk, and what the person thinks is that this doesn't work. Rather, it's the person who made the decision to go excessively on risk, and it's ultimately your fault. So these two need to develop together, and what's going to refine that and optimize it is having good risk parameters in place. So you're going to assess data or fundamentals, volatility, probabilities, parameters as you refine your model. You're going to go through the same process: discovery, understand market structure, extract, separate, and refine. So internalize specific aspects of the market and consistencies in price behaviors in your model. And then ultimately, the risk is the governor. The mind develops as the model develops. Okay, so they're both developing concurrently through structured experiences that you've created, a structured development model that you've created. It's the only way that this can happen, is it needs to be methodical and process oriented. So I will leave that with you for now, and we'll get on to the price behavior in the next section.